factoring. Partnership factoring is a very similar product to full service. Now, you still put all your invoicing in, you're still into a contract, and basically what the difference is with full service, they automatically give you 80% of the invoice when they receive it and they verify it. They fund it into your account. With partnership factoring, they have the two-prong same fee structure, but they work on a different type of fee structure. If you did $1 million with full service, you know if all your debtors paid in 30 days and they said 3% a month, well, it's going to cost you $30,000 to do the facility. That's assuming no one's ever overdue. With partnership, they work on your turnover. So, say for instance, they wanted to charge you a 2% service fee. It's going to cost you, on $1 million revenue, $20,000 for the year. Now, this is very hypothetical. I'm just throwing figures at you. But basically, 20,000 divided by 12, if you did your normal factoring, whatever 20,000 divided by 12 is, you know, $1 or $2 grand a month is coming out normally. The other way it was costing you $3. This way it's costing you, less than $2,000 a month. Now here's the interesting part. You're allowed to take up to 80%, but you can draw it down when you want. Sending an email in, and if you've got $100,000 worth of invoicing in week 2 of your month, and you don't need the 80, you don't need it. You won't pay anything for it. But if you only need $10,000, you draw 10. Now, once you draw that 10, you pay an annual interest rate of about 11 or 12% per annum, and it fluctuates. But that works out to be about 1% on the 10 grand, not on your full debtor book. What happens if a debtor goes bust? Yes, it's happened. It's happened a lot, unfortunately, in the last 5 years, especially in Queensland with all the floods. But this is where it comes down to the age-old saying, if you spread your risk, then it's. I know it's still hurting that the debtor's gone and you've done all the work or you've supplied all the goods for nothing, but you're still able to trade on. Now, if all your eggs are in one basket, obviously, you're going down with the ship. That's the way it is. But with the factoring firms, if you've got 3 or 4 debtors and one particular falls over, now most of the factoring firms would have seen e-alerts or something, unless those floods that came through earlier this year for Queensland, that is the negative of it all. But you can't help those sort of situations. But if there's other debtors in your book, what the factoring firm does is basically holds the invoicing that is outstanding and works in with the client and starts to buy back those invoices slowly and carefully so that you can continue to trade on. If a debtor just disappears, well, the factoring firm, if they feel that you're left vulnerable, they will chase the debt rigorously. They want to get the payment, but at the end of the day, the debt's owed by the directors and they have to make means of paying that back to the financiers. So, tough times ahead if one debtor falls over, very tough if 2, but most cases factoring firms or debtor finance firms will work in with you so that you can continue trading and that can go through its normal collection periods through creditor meetings, etc. Yes, I thought someone would answer that question, ask that question. Security. Now, most cases in debtor finance, there's an application form signed. There's normally a personal guarantee by the owners or directors. For the tough facilities, there's property, but it's probably 10% of the facilities out there. But most of the time, the factoring firms take real stringent security on the debtors. Now, if you've got an overdraft or a business loan or a line of credit, often the banks register a personal interest against the debtors themselves, making it extremely hard, if not impossible, for the factoring firm to factor. So you've got to put that in mind when you're applying for debtor finance, that you haven't got your banks with security over your debtors. Now, the Personal Securities Act, Personal Property Security Act, I think it's called, has been out since February this year, and it replaced the fixed and floating charge. Now, it'll take 2 years for the register, so we know exactly where everyone stands and where all the registrations are. But at this stage, it's left to the clients to interview their bank and make sure that the debtors are unencumbered. But if it's a good facility, that's all that's required. There's a personal guarantee from the owners, directors and the debtors as security. Thanks, John. I see a question there in relation to what clients suit factoring. Now, basically, any client that invoices on a particular terms and the goods are delivered or signed off or received and then they're going to be paid in 0 to 60 days is eligible for factoring. What makes the client uneligible is if, and I don't mean uneligible, makes things tougher, is if they only invoice one debtor. Their invoices don't get paid in 90 days, they're outside terms. It might be a new business startup, but basically all the other businesses, no matter what industry, should suit factoring. There are a couple of industries that are a little bit harder to write. The retail clothing industry is very tough because the margins are so tight, and often they deal with mums and dad businesses. Now, I use that term loosely because normally it's a sole trader. They're individual sole traders and not exactly PTYs, and I know they don't say it, but they sell their items on consignment in shops like that. They rely heavily on selling garments or stuff like that, the retailers, and if they don't, then they obviously put the factoring firm out a little bit longer and hence charges the client more interest. The same thing goes with publishing. That's been a pretty tricky industry over the years. Everyone gets an advertisement in the local magazine. We put the full page in, might cost us a few grand. At the end of the 60 days, when payment's due and they haven't noticed any real leads come in, it's when clients, if they're tight, they'll say, oh yeah, look, we'll put off paying that a little bit longer. And I know that's not for every publisher, but that has happened and that's caused a bit of friction in the past. But in saying that, the good industries are labour hire. They are very lucrative in debtor finance and often get the best rates. Transport's very lucrative in debtor finance, but with the transport industry, businesses that have 5 to 10 trucks up get a very good facility. The ones that only have 1 or 2 trucks normally have to fight pretty hard because there's only normally 1 or 2 drivers and they normally put all their eggs in one basket and only work for one debtor, which makes those facilities pretty tough. I hope that's answered everything that you required. Trade finance. Very difficult product to get and in most cases requires assets in a business or personal property as security, or simply directors having property so they have something to lose. Now, the reason I've covered trade finance in this particular webinar is because it's a very handy tool to have, and there are some debtor financiers that actually offer that as well as debtor finance. So there's an exit strategy. So if you're purchasing in from a particular country, it lands into customs, you invoice it out, then getting debtor finance will ensure that the trade facility is paid out as an exit. Now, these lenders will help with the trade, but there are certain criteria, and I will explain that I'm not a guru at trade finance, but I will make sure that if you do go this way, that all the information is provided in front of you to make a legitimate decision, whether it's for your company or not. I'll just stop there for a second. I see a question there of how long it takes to set up a factoring facility. Now, with the private lenders, obviously they can move relatively fast because most of them only have a single page application. They're just trying to get a bit of a feel around your business, your invoicing, your structures, and they can make a decision on the spot, which it could be signed up in less than a week. However, most of the time, those smaller lenders, their fees and charges are a little higher.
Don't forget to click the link in the description for more information on this product.